Okay, so you want to buy a farm. Most people look at farmland and see hard work, unpredictable weather, and dusty tractors. A low-margin chore where family farmers break their backs just to break even. But behind closed doors, the richest human beings on planet Earth are playing a completely different game. Bill Gates isn't just a software pioneer anymore. He's quietly built a portfolio of over 275,000 acres of American farmland. Jeff Bezos, Thomas Peterffy, and massive Wall Street hedge funds are quietly outbidding local farmers for every single tillable acre they can lay their hands on. Why are tech titans and financial oligarchs pouring billions of dollars into literal dirt? Because while retail investors chase volatile tech stocks and crypto tokens, the world's elite have unlocked a terrifying financial secret. Farmland isn't an agricultural business. It is the ultimate unshakable monopoly. By the end of this video, you'll know exactly how the hyperwealthy turn simple soil into an invincible cash machine, and how they exploit a hidden asset class that you pay for every single day of your life. To understand why the ultra-wealthy are obsessed with dirt, you first have to look at the staggering price of entry. If you're a local farmer trying to buy a modest 500-acre family plot in Iowa or Illinois, you're looking at around $10,000 per acre. That's a $5 million entry fee just to get your foot in the door. For a regular family, that requires massive bank loans, collateralizing your home, and praying that crop prices don't collapse. But billionaires don't buy single farms. They buy entire regional agricultural networks. When institutional players move in, they execute mega-scale portfolio acquisitions, dropping $200 million to $500 million in a single wire transfer. They aren't just buying dirt, they are acquiring senior water rights, subterranean aquifer access, and massive infrastructure pipelines. And here is the hidden hurdle that nobody talks about: the regulatory maze. Navigating foreign ownership restrictions, complex water allocation rights, and local zoning laws requires a small army of specialized lawyers. In states like California, owning the land is almost useless unless you control the historical water allocation attached to the deed. If you don't control the water, your $100 million investment becomes a useless desert overnight, which brings us to an incredible question. If the operational costs and regulatory hurdles are so insanely high, how does this asset actually make money? The answer lies in a hidden core revenue model that most people completely misunderstand. Think of farmland like owning a prime commercial building in downtown Manhattan. Except instead of renting office space to tech companies, you are renting fertile dirt to industrial farming operators. Billionaires almost never drive tractors. They don't harvest corn, and they certainly don't worry about wake-up calls at dawn. Instead, they use a triple net lease model. They lease the land out to expert tenant farmers who handle all the labor, equipment, seeds, and operational risk, while the land baron sits back and collects a guaranteed cash rent check every single season. It's like owning a bakery, where the baker pays you rent to use your kitchen. But every loaf of bread he bakes also increases the value of your oven. The popular misconception is that farmland investors make their fortunes selling wheat and soybeans on the open market. The cold, hard, data-driven reality: the real wealth isn't generated above ground, it's generated on the balance sheet through a dual-engine cash machine. Engine number 1 is the steady cash rental yield, which delivers predictable 3 to 5% annual returns regardless of what the stock market is doing. Engine number 2 is raw land appreciation, driven by a brutal economic formula that never changes. Population growth increases food demand while urbanization permanently destroys fertile soil. Supply shrinks, demand explodes. The value of the dirt goes up year after year, decade after decade. But here is where the psychological engineering gets truly sinister. Billionaire farmland ownership isn't just about passive rent. It's about strategic control and tax optimization engineered at the highest level. The ultra-wealthy don't just pick random crops. They optimize land layout and soil chemistry to maximize long-term asset value. They convert low-margin row crops like corn and wheat into high-margin permanent crops like almonds, pistachios, and avocados. Converting a cornfield into an almond orchard can triple the revenue per acre, but it requires waiting 5 years for the trees to mature. A regular farmer can't afford to wait 5 years without cash flow. But a billionaire can easily absorb the wait. They intentionally play the long game to price out local competition. Then come the industry secrets that normal investors never hear about, starting with government farm subsidies. The federal government spends tens of billions of dollars every year subsidizing agricultural risk. Even when market prices crash or severe weather strikes, taxpayer-funded crop insurance guarantees baseline revenues. The billionaire investor receives guaranteed safety nets backed by the government. while deducting massive equipment depreciation, soil depletion allowances, and property tax write-offs against their other income streams. And if they ever decide to sell, they use 1031 tax-deferred exchanges to roll hundreds of millions in profit into new land without paying a single dollar in capital gains taxes. It sounds like a foolproof money cheat, doesn't it? So why do some of the smartest money managers on Wall Street still suffer catastrophic multi-million-dollar failures in this market? Welcome to the side of the business that land brokers will never show you. When farmland investments fail, they fail with spectacular, devastating speed, and it almost always comes down to two fatal mistakes: unmanageable debt and geopolitical blindness. Take the notorious case of Harvard University's high-profile agricultural collapse. In the mid-2000s, Harvard's multi-billion-dollar endowment management company decided to aggressively buy up vast tracts of agricultural land across South America, Russia, and Australia. They poured over $1 billion into timberlands and farmland, assuming that scale alone would guarantee massive profits. Mistake number one: they ignored local water security and environmental regulations. In Brazil's Cerrado region, they bought land that lacked sustainable water sources, sparking severe local conflicts and regulatory backlash. Mistake number two: they over-leveraged their international operations while ignoring geopolitical currency risks. When local crop prices swung and environmental opposition mounted, Harvard was forced to write off hundreds of millions of dollars in losses, quietly selling off ruined assets at massive discounts. A similar disaster struck debt-fueled agricultural syndicates in the American Southwest, where investors used massive debt to acquire thousands of acres relying on deep groundwater wells. When the local water tables plummeted and drought dried up regional canals, their debt payments stayed exactly the same while their crops withered to dust. Bankruptcy was instantaneous. This brings us to the ultimate moment of truth. When you run the actual numbers, does farmland truly deliver on its elite promise? Let's run a complete, real-world financial simulation on a hypothetical $10 million institutional farmland acquisition. You buy a prime 1,000-acre parcel of high-quality, irrigated Midwestern cropland for $10 million. In year one, you lease the land to a commercial farming operator under a cash rent agreement at $350 per acre. That generates $350,000 in gross annual rental income, delivering a clean, predictable 3.5% cash yield. Over that same 12-month period, historical land appreciation averages roughly 6%, adding $600,000 in equity value to your underlying dirt. Your total combined return for year one isn't 3.5%, it's 9.5%, and unlike volatile tech stocks or corporate bonds, this asset has nearly zero correlation with the broader stock market. When the market crashes, people still need to eat. When inflation surges, food prices rise, driving land values even higher. Your initial payback period to recover your liquid capital through rental yields and strategic refinancing is roughly 10 to 12 years.